I actually worked on tour with Take That. If you guys knew.
Oh,
that.
you said this before. Yeah, it's fucking mad.
Yeah. But anyway, I was helping set up in their launch.
That's really got his hairstyle from look.
Yeah.
Cowboy slick.
Want you back for good. So anyway, I was
best pop song of all time. Just saying. Viewers, listeners, welcome back. Episode 37. We are pretty early hours, still pre-Christmas whilst we're recording this. FYI, day after the Bank of England has just announced its latest rates. So we're going to go through some inflation data and then Bank of England rates. Talk about how we think that might affect the market, what we're looking at for 2025, crystal ball gazing kind of shit. And then we got a lot of questions to go through. So this will be a bit of a mixed bag today. Stuart's going to join us shortly. He was out on the slash last night, but he'll be in the next 20 minutes, I think. So let's crack on and go through.
Sent us a video of him getting pulled over by the feds.
Is that what that was? I didn't see the video. I just saw
he got pulled.
He got pulled. Boy.
Roundup sound, ooh, yeah. Real estate deals. We lay them down, let's get those deals. Deals making money, baby.
All right, let's have a look at this quick then. So UK inflation was higher in December. So UK inflation hits 8-month high of 2.6%, fueling calls to hold interest rates. They think from some of the articles I've seen, it seems to be they think inflation's rampant or coming back because of diesel, petrol prices and clothing, I think was the other one. But I've not dug into it in too much detail. At the end of the day, I just don't believe anything they say when it comes to inflation these days. Ultimately, they keep printing money. They can't balance a budget. Then there's going to be more stimulus. There's going to be more inflation. So take it with a pinch of salt. But petrol and diesel prices were up a bit. So that is something tangible. And then just to give a snapshot for anyone who's listening and can't see the video, we're currently looking at a graph of inflation rates from 2015 to present day. You see that nice juicy spike in the middle that fucked all of us, and we're still trying to get out from underneath the litany of issues that caused us on our development sites.
And this is this is quite smooth. This isn't the reality. Like the reality was much worse than this.
Yeah,
in my opinion.
Yeah, if you went construction industry and created an index of key materials that you need on sites, then yeah, this thing suddenly starts to look like it spiked to 25, 30%. Like it's crazy shit. But yeah, so between 2022 to 2022, 2023 were shit years, basically. 2024 was bearing the fallout of those shit years. And now we're back down around the 2% levels. I don't think it will fly again. But let's just look at the Bank of England first, and then we'll come back to what we think the market's going to do. So the Bank of England did decide to hold rates at 4.75%, which 90% of the financial markets predicted. I think that's pretty obvious when the print started to go up on inflation. But that is it for just the articles there. So what do we think, guys? What do you reckon next year? Obviously, none of us know. No one knows. Bank of England don't know. Literally no one knows. But what do we think next year? We feeling lucky for next year?
I think it's an early sign of obviously the government is not making life easy. I mean, obviously, so they put it down to mostly energy prices, food prices, tax increases, and global economic conditions. I mean, the tax increases is predominantly lent on the national insurance, national living wage increase that we've done. So all companies have basically semi-up their prices. And I was actually chatting to the governor of a private school yesterday, and he was saying that the private schools that have obviously been hit with the VAT tax claim, they've had to basically share that. So the 20% increase for the client or the parent, they're kind of like increasing their pricing by 5 to 12% depending on the size of the school, and it's going to be survival of the fittest. And then obviously the parents have to then make up the rest of the difference. So what is happening is tax increases are meaning that everyone's putting their pricing up, and it's that knee-jerk reaction. So I actually was surprised I would have been surprised if inflation wouldn't have gone up. And obviously, we've been working for the last few years to get the inflation down, and Rishi did a fairly good job of stabilizing that, because a lot of the change in inflation was out of government control. But now they adapted and they're returning to that. So I think it's the first sign of uneconomical understanding by the government to change things. And I think that I think it probably won't get better until it gets worse, in my opinion. I hope that this is like a stab in the kidneys for the existing government, and helps them, be a little bit less bullish, because they've made a tweak and it's basically turned out the wrong way, whether they expected that or not.
A tweak. You're gonna have to be a bit more accurate than tweak.
Yeah,
They
yeah.
took a nuclear bomb to our economy.
Yeah, I mean, they've obviously, they're in the power now, and there's a lot of things that they do want to do, and they've started with a few, so it could have been a lot worse. And it's going, and we're the public going to be feeling that backlash. So all of a sudden, it's gone. Conservative government shit. Let's move over. Which to some degree, I feel that there was areas which were not really getting addressed as hard as they needed to be. But now we're in this Labour government. They're doing the exact things that a Labour government would do, and that's making it more costly for the flatten the gap, make it more costly for everyone else, and tax everyone more, which they're doing. This is all of us as a result of that.
Well, I think there's also a huge second order consequence to that same issue. So that what you're referring to, obviously, although it comes into effect in April, some of these new tax rises and things like that, which is ubiquitous across the UK, rather than just niche to like the energy sector or whatever, that can affect everything because everything relies on energy, but those can be isolated markets. But taxes affect literally everyone, especially NI, and people are starting to price that in anticipation for April's increase. But what's the second order consequence is that our country relies a lot on foreign investment and a lot of institutional capital to go into sectors to drive competitiveness. But we're seeing less and less of that because it's less tax advantageous to foreign capital. So then we're going to see like an ossification if they don't sort out the tax issues. And that's going to mean like less competitiveness in certain markets. So therefore, costs are just going to stagnate or just keep going up in line with the taxation and in line with people then wanting more wages. And we're just going to see this this gradual sort of demise of pricing and people just feeling the pinch everywhere. But that will take, I think, a bit longer to kick in, probably like 26, 27. No one really knows. But whenever they up taxes, there's always this lagging effect if there's no incentive for businesses to invest. It's stupid.
Yeah, I mean, if you look at this time of year where it's cold, it's a cold environment, everyone's using heating in their houses, it's Christmas, the majority of people spend more money on food during this particular part of the year. The tax increases is actually more pushed on to the businesses, but those are the two main reasons that we've had an inflationary increase, and they're two massive chunks of what people spend in December. So it's also going to hit us even harder that our spend in December is going to be greater in those two camps. I mean, above energy and food prices, the top two costs are mortgage costs. Well, that's probably it, actually. Mortgage costs. So it's
probably mortgage costs and vehicle costs, probably, but yeah.
Which
I would
again is fuel taxation.
I think because whenever I think about this as well, similar thoughts to you there, Jack. It's still quite fresh, and new decisions have been made which are having quite direct impacts quite quickly on certain things. Obviously, the news article you shared there mentioned the risk of stagnation, which is a risk if their policies. UK suffered with productivity anyway, but if their latest policies are brought in because they need to raise funds, but it does have another impact on productivity in the UK, then stagnation is obviously going to be an issue. But if inflation keeps going up as well as stagnation, then we have obviously stagflation, and that's going to be really, really bad. I don't see any good out of that at all. So in terms of where I see, though, to answer your question, the rates, it really hinges on that, because it's hard to see exactly what's happening rather than it being seasonal a second. But if there is stagnation, they're going to have to, if the market stagnated, they're going to have to reduce rates to get it going again, or do some other fiscal policy change. Or if the inflation keeps going up whilst we're still stagnated, they're going to end up increasing rates to try to control it, and then that's just terrible for everyone. So fingers crossed they can figure out a different way to increase productivity, or it does come back around.
Well, the real solution is that they just got to fucking look at America. Like if we can't balance a budget and we're costing too much on the taxpayer for inefficient government spending, then it's never gonna. It's like the raising taxes, interest rates, inflation. They are like stigmas of an inherent issue we have where we're spending over $1 trillion a year in this country and we're not getting $1 trillion back in taxes, and then we're increasing taxes to try and do that, screwing businesses. Rates are high. Inflation's a global issue as well as a central issue here. It's just stupid. They need to be more efficient with government spending, and that will then at least help ease private sector pressure, which is exactly what America's trying to do. And I think next year, this is the only optimism when we're talking about sort of forecasts in 2025, that hopefully what happens in America will be mirrored across here in Europe and the UK. And hopefully, I mean, we are seeing it in Europe, to be fair. Europe is starting to also have some of this rhetoric around like government spending and government efficiency. I don't know if Europe will move for a long time, but the UK is a bit more forward thinking. So hopefully we see good stuff in America, and then that reflects on our issues here. And then we might see changes over the next 4 years, but it's not going to happen quickly under Labour. But anyone listening, yeah, hopefully we don't see any of the craziness of the last few years. I think it is probably just going to be more of like a stagnant pinch, and you just got to try and be as good as you can as a business owner to find more margin, to be more efficient. What's the advice, guys, to anyone out there looking at the year next year, where it's going to be a hard year? I don't think it's going to be an easy year compared to what we have. It'll be easier, but I think there's still going to be this overall. You've got to compete, otherwise you're not going to make it through 25. What's the advice?
Yeah, I think my first bit of advice for anyone is there's always going to be excuse makers in business and in property, where they go, oh, I didn't want to do much this year because of Brexit, or I didn't want to do that much this year because of COVID, or I didn't want to do that much this year because of the Labour government. I think you can still build and grow a business in unstable markets if you're on your eggs and make the right decision. So the best time to to plant a tree is yesterday or 20 years ago. Still don't be afraid to step into the market, but just be more cautious of how you're exiting those particular schemes. Out of all of the projects that we're delivering, there's only really one that we can't refinance, and that is refinance, have all of the capital back out of it, and the rent covers the mortgages, even if mortgages increase by 1%, 2%, 3%. And that's our luxury scheme in central London. So and that's out of 5 projects. So why wouldn't you get out there, start building your business, start learning, start with a small, if you bought a 1-bedroom flat and moved the kitchen into the living room and created a 2-bedroom flat and either refinanced or sold it, that's fairly low risk in terms of all this. Rents are still in high demand. Rents will probably be going up with the inflationary marker. So don't be discouraged by all of this talk in the industry to not do anything. You've definitely got to be, in any market, I think you need to know your numbers and know the risks and stress test that model. In the ground up network, in the spreadsheets, I show like, if interest rates do this, we still don't lose money. And it's unprofessional people in the industry that will. I know an underwriter of a very large bank, and when I was chatting to her last year and interest rates went up, she had a buy-to-let property, and she was actually putting money into the buy-to-let property every month because the mortgage rate was higher than the rent. Now that's like what I would call like kind of an accidental, unprofessional landlord. Like if you're this, I don't want to naysay the person because she's a brilliant person, but she's underwriting £5 million deals for developments, but has a buy-to-let property that doesn't stack up. So if you know and put this in perspective. I don't even know what number of properties we're up to at the moment. It's over 100. Not one of those was in negative cash flow position. So you can still grow, and business is arbitrage, right? It's someone's current state versus desired state, and the obstacle in between is where you make your margin and arbitrage that margin. And there's still margin to be made in any market. Arguably, the more volatile the market is, the better the margin to be made. So my only advice is just rerun your numbers, stress test them from a financial perspective, stress test them from an exit perspective. Think, if I can't do this on the exit, i.e. sell this flat, what are my other options? Can I let it out to social housing? Can I let it out to the council? Can I let it out to any Tom, Dick or Harry? But don't be put off by it. I think that scale is 100 times more difficult in this market, because every problem is amplified. Our non-executive says that the faster your business is going, it's kind of like driving a faster car. So problems come at you quicker, and you need to understand how to manage those problems. So if you had Lewis Hamilton in the driving seat of a Formula One car, he's going to swerve a problem quicker than your nan driving the same car at the same. So you've got to skill up, and it's you do have to be a better business owner in these markets, but there is value to be had.
What do we think the best property strategy will be for 2025? Or do you think it's still much the same? Go for high yield, stay away from, high street shops and shit like that. What do we think?
I would normally say I think the best strategy is getting planning uplift on buildings, but planning is obviously super slow. I think it depends on where you are in your business and your property business. I think the more simple it is, and you can rinse and repeat, like your HMOs, Ryan, like Dorian social housing. I mean, Dorian's taking very low risk. He's taking it through planning and then selling it on at that point of planning consent. So we're probably taking on more risk from our development perspective, private development perspective, but we just do less volume and higher margins than Dorian does. So I think that finding something that works and just repeating it, because it is low risk. Like we would, it was quite funny in COVID, for an example. The first lockdown was literally like upon us. We were bidding on quite a big site, actually our biggest site at that time, which was a block of 14 flats. And I analysed the risk that my rent roll paid the mortgage and I could add double the building in value. So I was like, in what world? And a lot of people pulled out of the market. This was like right at the height of it, and actually why we secured it at a big discount. I was like, in what world does this deal not work? When when COVID gets really bad, that business just actually isn't a thing anymore, and people are just fighting for safety and health. And in that Armageddon scenario, you don't really have to probably worry about the bank coming and knocking on your door, because they're all around their families' houses. So analysing that risk of like, if everything goes wrong here, what happens? And that's how we looked at deals in that time. And I think that's now how we just continue to look at deals now. And it's quite healthy to do that. So repeatable strategies that you get to know, they're close to home. Start with what you're comfortable with. We've definitely learned with our social housing portfolio that if we grew it less, we'd have had a lot less to manage and firefight, because that market moved huge. And the issue that it brought upon us is, if it was half the size, we could have funded and bought our way out. But it's because it's such a large portfolio, the problem's greater and it's more difficult to find solutions. So yeah, keep it under your control. And I would say that, stress testing, exit testing, sticking to what you know, and doing something repeatable is low risk. And repeatable could be HMOs, it could be renovating flats, it could be it could be anything really.
Yeah. What about you, D? What do you reckon? Good strategies.
Well, business, very, very simply, is I think Alex Harmozy said it from a retail point of view. Sell things to people that cost you less than obviously what you sell them for, and so make profit, and do that many, many, many times, and then you'll make money. So property is kind of no different, really. Whatever. The only problem is we have added nuances. Is that all of ours and I've worked actually with retail investors, not necessarily retail in the definition that they've not done a deal before, but retail in the definition that they're from a retail background, and that is kind of the mentality. What if it's not making you money, if you're not selling it for more, or renting it for more than it's costing you, just change it. Because in retail, you might have some stock, but ultimately you can change a price point quickly. Whether you can make a decision on Tuesday and it'll affect sales on a Saturday, or even on the Tuesday. The problem we've got is we enter into 18 to 24 month, 12 to 24 month contracts, and so we've got the added. So our base point is, what can we do that's going to cost less than what we sell it for, or we sell it for more than it costs us? But then we have that added nuance of that we've also got to try to predict the future as well. And that's where the mistakes come from, because everyone can look at a deal today and know, what, in terms of right now, what it's what it rents for, and what the mortgage is today. But we're going to lock stuff in for 2 years, 3 years, 4 years. Our average cycle is 4 years, and then our average, most of our portfolio mortgages are on 5 years. No one really knows what you do from here. So Jack started talking about is once you've got the fundamentals set in any of the strategies, it is trying to be a bit more devil's advocate with the future, and look to how you can de-risk really. And there's no easy way to say it. You're going to be wrong. You're going to be wrong sometimes.
I'd say you can hedge though. So on the de-risking part, which I completely agree with, if you look to the last few years, to me, the best advice going forward is to anticipate that the same thing might happen again. It might be worse. And what worked for us, and I think you guys would agree with this. Dorian, your model is slightly different, but I know that where we look to retain schemes, or where Jack might be selling into the private sector. It's slightly different, just where your exit's more of a sure thing. You take the risk of the planning and that duration, and that causes a lot of headaches and stuff. But for anyone out there dealing with the cold face of the private sector, I would say you really, really want to diversify your development strategy. Don't do Depending on where you are. Obviously, if you've got the aptitude, if you're a seasoned developer, then you can sort of do what you like. But if you are trying to scale, if you're in a position where you're starting out, I wouldn't go and take on, say, 3 large projects. You really want to take on a large project and you're capable, take on 1 large project, but do some smaller wins as well. Don't put all your eggs into one basket or one strategy basket. And if you really can, the best thing I think you can do, and this is what saved us over the last few years, is have a fucking trading vehicle and try and build up a consistent revenue stream that helps subsidize your overheads and your running costs. And ideally, you're making a good 5-10 grand a month coming in from another revenue stream, and that will help you and help ease the pressure on your living and your living standards, so that you're not having to take and reliant on fees that you could pull out of these schemes. And if there are issues in the future, that could end up leading to you having to borrow more money just to pay for living costs, and then you're stacking up debt on debt on debt. And we've seen that happen to quite a few developers over the last few years. So if I was starting again now, I'd be quicker at building up that servicing vehicle, whatever it looks like. Could be a sourcing business, could be a mentorship kind of business. Depending on what you do, you might be a really good QS and you could mentor some people as a QS. You could have time in your diary for a part-time job. Whatever it is, I think you need a revenue stream outside of just relying on your developments to pay your wage. I don't know what you guys think on that, but I know we've spoken on the topic before. But I think people looking to scale
Definitely.
should be
Is
aiming for that.
definitely. Yeah, I don't. I would class it as like non-negotiable. I think we've said this before. If any advice to anyone getting into the sector, have a trading kind of or some other form of income that deals with your personal life away from the development business. If you can get that cracked, then then it does take pressure off and it makes your decision making a lot clearer. So if you haven't got that sorted, I think for 2025, that should be the number one strategy. And then same thing though, as you said, Ryan, when you do get into development, this is advice the 3 of us have probably received in the past and haven't taken it, but don't rush, don't do too many at once. And it's very, very, very hard for an ambitious entrepreneur to listen to that advice. It's really, really difficult because you don't know it's going bad until later on, so far in the future, in this type of in our type of strategy, that we're just impatient. So if you did have a different trading business as well to put your focus on whilst doing that, it would also de-risk you mentally, sabotaging yourself potentially.
No, I completely agree with that, mate. Yeah, because especially if you're driven because you just want to do more, and in property development, that do more consequentially can mean more debt, more liabilities, more risk. So you got to take the ambition and have a risk adjusted mentality where you go, okay, it's good to be ambitious, but I need to focus my efforts on diversification so that at least if you're scaling out a trading vehicle, or you might just simply go, I'll have one big site running. and that's like my focus, and I'm working on that big site. That's my £1 million payday. But I'm also going to do some quick win HMOs or some smaller apartment flips or some smaller buy to let flips or whatever, and just do them on the side. Keep you busy. Should make some good money out of it as well, and that can help subsidize other parts of your business. But if you just put your eggs in big baskets, we've seen too many people fall flat on their ass over the last few years, and you just got to be super careful.
Yeah.
Jack, you got anything to
See,
say on that?
I'm the definition of that at the moment. You know, that is, I have the main business is in one strategy, and it's the golden eggs in the basket, so to speak. And you
Mm,
hear in business, you hear both sayings. You say diversify, and you also hear the other saying. If you know, you don't need to overly diversify. You just
mm,
need to protect your golden eggs, basically, as like
yeah,
Warren Buffett says. But there's kind of, and what I just tell people is there's no right or wrong until you prove whether it's right or wrong.
yeah. I
It's
think
Yeah.
a concentrated focus is super important, and we don't want to like undermine that. But obviously, in bad markets, concentration can be your
it
demise, and
comes
that's
it comes
yeah.
back to what Jack said though, right? Because you can diversify, but if your business gets too big, the diversification isn't really going to protect you because
Mm,
like you know, this business, right? We're now turning over tens and tens of millions a year, and the pipeline is even bigger. We need obviously debt to do what we've done, and the debt is in the millions of pounds, and the forecasted profit is in the multi millions of pounds, and it's so big that my to diversify it, I would need another vehicle in a different sector or a different strategy at a significant scale to counterbalance that risk now, if that makes sense.
mm,
So, I think in our sector, diversification definitely obviously works if you do it slowly and you're building something. But if you've built a business from a plan and really launched and scaled it and it started getting really big, kind of like what Jack did with the power with the social as well. You know, just went straight out and bam over 100 units, and it's just like
mm.
it gets to a point where it's so big that your other strategies really help, and that's what Jack has obviously has helped him. But clearly, if that portfolio was double the size of that before the problems started happening, then you can really see how your diversification strategy would need to be just as big, and
Yeah.
then that becomes really problematic.
Well, you'd be you, Dorian, are the example where you'd have to forecast and start working on like a dilution strategy, wouldn't you? Where you dilute that core part
Your
of your
problem
business.
is, yeah, sorry, Ryan. The problem is every time, and any business owner, if you're looking at this, every time you do a forecast, it looks so good that you say to yourself, "Why the hell would you diversify? Your
Yeah.
forecast looks fantastic. You need to double down."
I know, but a business like yours, quite an interesting experiment, really, like just a theoretical experiment to think of, like, well, how could you take Castell and dilute its exposure to that one core strategy whilst not distracting from the core strategy and the
Got a plan.
scale? Go on then,
I've got a plan.
if you can explain,
Well,
go on,
so I'm
explain.
working on something at the moment. Well, yeah. It's always been in the back of my mind. You know, I've got portfolios like you guys. In fact, I've had to sell my portfolios to fund this business. So, you know, and so I completely what I would say, right, is that as well in a challenging market, and my business went through a challenging time, you've got to really make a decision. Do you want to, with your forecast, do you think you can see this through? And if you do, you have to go into what some people call as war mode, basically. And you have to sacrifice everything short term. You have to liquidate other assets. You have to come out of other ventures to focus on something that you know isn't going to really return anything in the short term. But if you get through this period of time, the rewards on the other end are astronomical, right? So you play a medium game term, so which is exactly what I did. But coming back to your question, in the back of my mind, I've always wanted to, in my first business plans, basically, like if you think about it, the factory deals come in, and we sell some. We sell low. We build a training business and we sell, but we're also with our when you're profitable, you can build a portfolio along the side. You can build a different strategy when you're making money. You can't do it if you're not making money. So coming back down to where we're at now, we're obviously a large company. We're still scaling. We're still absorbing capital. But I'm currently in conversations with a potential joint venture partnership with a fund where we use our skill sets to, in addition to scaling our business, we scale a portfolio that we forward lease to local authorities on 20-year leases. And they fund it all, and I get a share of that portfolio rather than owning all of the portfolio, because again, it's capital intensive and money tied up. But they fund all that, and that's hopefully in 8 figures some as well. And then that will start over time. Will start counterbalancing the risk of just the trading business. Hopefully.
Nice.
Just wanted to dive in back onto a point we were saying about in these markets, Ryan, you were saying about growing a service-based business or a quicker cash flow-based business. One thing I would say is there's businesses that you can grow where you look at it and you go, problems get smaller as this grows, or problems get bigger as this grows. Dorian's quite clearly pointed out his business and my social portfolio. The bigger it gets, the bigger the problems become, and the more you've got to do and the more you've got to feed the beast. There are businesses out there that people can add value to the market where you actually go, well, if I take on a 10% growth pattern, the problems become less. And it's those businesses that you should start with, build the cash flow and income that then enable you to sort of deviate into other areas. A perfect example for this is Ben's architectural practice. He wanted to grow it to £1 million revenue and get out of it within a few years. It's now up to £1 million revenue. He's out of the business. The MD runs it. He has more inquiries than he can deliver. He doesn't want to grow the team because it becomes more of a problem, and it brings more problems. So he's got an efficient, lean team, good margins, running that company super efficiently. He could take that to a national architecture practice, but he's actually decided to keep it a cute little business. It's his livelihood and income and roof over his head and pays the mortgage and blah, blah, blah. And then the passion growth is in the surveying business. So it's just, that is going to be a national business one day. The development company is super demanding from a time, stress, financial perspective. So it's about having that blend of growing a business that you can go, right, let's for the listeners out there, let's have 3 ideas of a cash flowing business that I could run. What do I know enough about to add value into the market? It might be insurance brokerage. It might be, brokering materials to site. It might be, window cleaning. It could literally be anything. And go, how do I grow this to a critical mass size? Because there's different growth sizes of business, or as of the size that I would call sort of very small enterprise, quite high margins, fairly low risk, don't need a ton of business, do a bit of commercial and residential, so it's not cyclical clientele. And how do I grow this to a size where it makes me good money, but it's not going to set the world alight, and I'm not going to be taking over the market share, but it is good. It's respected in the market. It's good value and high cash flow, and that is a good place to be in. That is very different if you're, for an example, XP and XP Surveys. We both want to grow those businesses more, and with growth comes problems. With growth comes cash flow issues. With growth comes, we won't take any cash today, but eventually it's going to be a high cash flow business. So we actually talked about it in the episode that we recorded just yesterday. Like, as long as you know why you're where you're at, you'll be okay. Because quite frequently it's sometimes difficult to go, when do we make money? When can I pull that out? When can I pull that director's loan out of the business? And sometimes you're on a complete trajectory where it's going wrong, and it's good to know that you're in that position. Sometimes you go, it's going to go right, but you need to know that you're actually prepared for what the journey is. And it's kind of like if you're whitewater rafting and you go off a waterfall, if you know you're going to just go down and pop back up, it's good fun.
Yeah.
But if you don't know where you're going, don't go off that cliff.
Yeah.
It's like yesterday, I was working all day, and in the evening, which ended up taking me to midnight, I redid our forecast for the next 12 months, and it always says the same thing, but this time it looks better, and I have a lot more confidence just because of where everything's at now, and we have a lot more reliable data, and the market has settled, or it did. I don't know what's going to happen now, but it did. And it looks good, and we're choosing to grow. We're choosing to take that short term hit, as Jack said, knowing that having confidence that it will come back. But I had I think I mentioned it before, but I went to a talk from the founder of the Leon food chain, the restaurants, and they said that as they were scaling, they were doing frequent forecast, and every time they did their forecast, it was showing that the next 3 months they were growing at a fast rate. The next 3 months is really hard, and then it gets better, and that trend continued for years, as not to discourage anybody. And then until he said, eventually, it did actually catch up, and when the forecast was green from now, and then it just started getting better. And then eventually, once you finally get to a certain level where you're not growing as aggressively, you're stabilizing, things can turn. If the fundamental business is sound, things
Yeah,
will turn green again, and then you become a lot more. You
completely
can
agree.
reduce your debt, you can increase your profit, and then you can sell basically if you want to,
Completely agree.
or hand over to
Our
a team
our
member.
our non-exec, every single time we meet with him, does the exact same thing. It's basically a bollocking the first time when we sit down and do anything with him. He builds out this assets to liability ratio list on our balance sheet because he's like, this doesn't look that pretty. I mean, we've got quite a lot of value of equity, but a lot of the debt that he's talking about is actually in future projects that's already in those schemes and factored on the balance sheet and the P&L of that particular project. So every time he comes in to try and sort of scare us, and then we go, well, that loan is in this project here, where we're currently looking to make a 46% margin on GDV. That's the risk that's actually better than the risk we were willing to take in the first place. If that deal turned up today again, I would do it in a heartbeat. And then he goes, well, what are you looking to make out of that? And we go, well, this value conservatively, if we halve the amount of value that we're looking to make out of it. And then he goes, oh, that's not actually so bad then. And it's, I quite kind of like it because it makes us justify what we're doing today for tomorrow. And it's all about that management, like exactly like you said, Dorian. It's either a sinking ship or it's a ship that just doesn't get the value that you need to get for a period of time, and then it just boosts. Same story with Shake Shack. Took him like 10 years to make a profit. He ran one branch of a burger restaurant for 8 years. When he opened the second, he then opened a third in year 10, still a loss-making enterprise. And from year 10 to 11, he like I think he like a million x'd his branches. So it just exponentially grew. And he said the first 30 years of his business was the hardest thing that he's ever done. And well, the first one he said he loved it, and then he said the 3 years thereafter he didn't even know what he was printing money, and it's just that.
Yeah,
But
and I hear, because I spend a lot of time around business owners and I speak to them, and I've got meetings already booked in for next year with founders of businesses that have gone on to exit and all that sort of stuff, and I try to get around those communities. And the stories are there's patterns in the story. Always there's some type of idea, risk taking, and it really is not working, and they're growing so
yeah,
fast, and they're absorbing cash, and they're financing everything, they're borrowing from everybody, and they're so close to going under all the time, and then all of a sudden they get to a certain mass, and it turns. And then the making of money becomes kind
yeah,
of, it's the flip
completely
side.
agree.
It just comes in so fast, and you're just like, yeah,
I actually I won't share who it is, but I was chatting to someone the other day who's like a very well known athlete, massively like one of my idols, sort of thing. Now running a successful business, and you just sort of assume everything was always hunky dory because they were super top of their game athletes. Literally paved their way through like recognition, funding, sponsorship. Done a load of really cool things in their career. Met a load of really knows royalty, first name basis, spends time with them, all of that sort of stuff. And I was chatting to them the other day, and it was just so humbling that he was basically telling me about something that a decision that he made in his life fairly recently, and he's not young, and he was just like, Jack, I had £8 in my bank account. That's how cleaned out I was. And for me to hear that, it just invigorated me to know that we're not alone, and these things happen. And you've got to, exactly like you said, get into war mode. You've got to put on the helmet and fight
gotta
at the
get
front
into war mode.
front on the front line, win get the morale back up, get the war back into a position of a winning position, and then you can retreat and sit in your high chair.
Definitely. Look, I've got my management team around in a boardroom once, and I basically said, and I just said, right, we're in war mode. This is what we're doing, right? This is, this is the strategy. This is the problem. This is why. This is who's against us. Is us v them, and this is, this is what happens if we win basically and get out of it. So, and it can go two ways. Like, and this is a question about radical transparency, like Ray Dalio put in his book of principles. But do you? I operate on that type of thesis with my team. If especially my management team, I'm completely transparent. Here's the problems. Here's the cash flow. Here's the forecast. This is what we're trying to do. This is why we're not hitting what we need to hit. And here's the risks for that. And this is what's gonna, like, when we look at our cash flow, we model it out, especially for the next rolling 2 months. And I highlight stuff in red, the things that can move. And I'm like, if all these move, this is what happens. And then if all these come in, this is what happens. And it typically is a story of two stories, a great story and a terrible story. And I'm like, right, this is what we all need to work on, right? As well as then the future stuff. But we're in a bit of a pickle. So let's battle out of it.
That good and great can be replaced for optimistic and conservative, can't it? Which I think we all fall foul of when you cash. That's the thing about cash flow models or forecasting. You always look at it and you go, "Oh," and then you change a couple points and you go, like, what's gonna happen?"
I'm watching fire.
Yeah.
I'm when it comes to cash flow stuff, I'm so negative
Stuart's
now.
falling in the shower, is he? Are you negative?
Yeah, we for anyone listening as well, we don't know where Stuart is, but there's videos he sent in our group chat of him very pissed, or at least all of his mates very pissed last night, throwing axes in a dive bar where they're smashing up all the tables. I'm not sure what's fucking gone on there, but
I think he went to one of those rage rooms and an axe throwing thing, but he obviously doesn't drink, and he got pulled over probably for drink driving. So he's done someone a favour yesterday evening. Someone else got slipped away while he was taking a designated driver for the team.
Naughty man. Sorry, Jack. Go on. You say about cash flow.
Yeah. So I naturally, interesting question for you guys, and I think I know what the answer is. And my sort of the guy that helps me in acquisitions, when I see a deal now, and for an example, let's say I've seen someone that's less experienced in development than I am, which isn't loads of experience, but less experience. They tend to have more of an optimistic view than I do. I just look at all the problems with it. I go, the IRR isn't up there. You're not going to get funding for it. The time frames are ridiculous. When you're going in sort of wide-eyed and eager, and someone brings me a deal and goes, I've got a deal. All you got to do is exchange in 2 weeks. And I go, what, on a fucking £2 million purchase deal? Good luck. I was like, come back to me when you got 3 months. And the way I look at it is just I analyze the problem, and I don't want to spend the time on something or the funds on something until I know that it's de-risked before there's value there. And I feel that that's a mindset shift that eventually just comes to a point where you're just super negative. You're just like, where's the problems? Can we resolve the problems? Yeah, let's do it. It's less about where's the margin? Let's do the scheme. For me, I just look at all the problems. I go, and the way that I just literally pick all the problems, and it's very rare that all those problems are solvable, and then we actually crack on with it. And it's normally we counter offer something else. I need this time and this value, or I can pay you this and then this. And if they come back and accept it, we'll do the deal. But it's just very unoptimistic is where I see.
I definitely agree. Yeah.
I was just speaking of solving problems. Do you guys know who Mark Andreessen is? Of Andreessen Horowitz.
Yeah.
So venture capitalist in America, very famous guy, funded a lot of huge startups, sits on the board of Facebook, things like that. Very, like, best mates with Elon, invested in Elon, SpaceX, stuff like that. And he said, he said the reason Elon is as successful as he is because he's not like any other business owner. He doesn't do middle management meetings. He doesn't wait for the information to flow up the chain and then go and do some R&D on the floor and it passes back up that chain and then solve the issue his whole time. And he doesn't have a permanent role in any of his businesses. His way of managing, and he said, Mark Andreessen said, the only person it's similar to in history, there's a couple, but the main one being Mr. Ford himself. And he said what Elon does is he goes, his whole time is spent on solving the biggest issue in each of the businesses and going straight to the floor, going straight to the field operative, straight to the engineer on the manufacturing line, going down there, solving the problem. and then going, right, cool, that's solved. Where's the next problem? And that's all he does, just solving problems with it, and obviously a bit of strategy on where to take the company. But he doesn't have a full-time role. And if you are going to be a business owner
But
in the modern day, then go on.
the only thing to caveat that, just so you know, and it's great, but just to caveat that, because I've read his stuff as well. You know, his companies are still very set up as a structured corporate
Yeah.
organization that have
Yeah.
chief operating officers, chief executive officers, chief financial officers. They have
Yeah.
meeting schedules, reporting schedules, deadlines, stuff like that. He just, but
Yeah.
you say, but him personally, he focuses on the, but if it comes back down to that tracking of your time and that like the Eisenhower matrix again, are you spending your time in that kind of top left quadrant, which is not urgent but critical type of thing. It's very, very
Yeah.
important.
But by no means am I good to reiterate that, because I'm definitely not saying you shouldn't have management structures, meetings, organization, stuff like that. But it's more that his approach and how he leads his business is not from an armchair with reporting back to him. He goes, fuck that, I'm going straight to see what the problem is. I'll solve it there and then. The team can manage the other stuff, and then I'll go to the next problem. But bear in mind, he is, obviously super intelligent and a great engineer, and he knows his shit. But that doesn't mean
Yeah.
it's not replicable. Everyone, if you know your business, if you know your trade, if you know your shit and you learn more about it, you can go and help in certain places. And sometimes issues happen because no one wants to make a decision down the chain. And sometimes it takes you to go in and go, just fucking make a decision. And maybe might not be the right decision, but making a decision can at least alleviate an issue, could create another issue. So you've got to be good at decision making,
Yeah.
but you need to make
80%
decisions.
of a solution now is better than 100% of solution when it's ready. That's
Amen.
what
Yeah.
Yeah, and
Another
on a very, very, very small scale, when because when you have team members, that's more possible. I would say as well, because it comes back down to what we talked about in the last one about Death Valley. When your business is small and scaling, it's really, really difficult. Like we're talking about their companies now, which are huge, but I've experienced it from a small scale. Now I've got a management team and then operatives as well, and there's a structure set up for both meetings and reports, and I can not go to those and they will still happen, and obviously I can get fed back information. But on a very small scale of sometimes when there's problems, I will let them carry on with the current structure and the day to day of what needs to happen. I will just focus on problems really at the time. So I can see it on a small scale of how that works, and it is really effective. On a large scale, that would, in a way, I mean, it would be easier to do that on a large scale, because if you've got the power to have really high caliber exec people who really know how to run ops and really know how to run finance and really know how to run HR, you don't need to be there. You need to be on the strategy stuff as the founder, basically, wherever your
strategy
natural
and
skill
solving
sets lie.
problems.
which
Yeah, strategy and
which is
solving issues. Yeah.
which is from a business owner's perspective why I think it's good to actually be in employment for a period of time, because when I was I actually worked on tour with Take That. If I don't know if you guys knew
Oh, you
that.
said this before. Yeah, it's fucking mad.
Yeah.
That.
But anyway, I was helping set up in their launch, which was
That's
Sunderland.
really
I
got
think
his
it's called.
hairstyle from. Look,
The
Yeah.
cowboy slick.
Want you back for good.
Big
So
tune that.
anyway,
Big
I was
tune.
I was
Best
I
pop
was
song
I,
of all time. Just saying.
I was
Sorry.
shipped up to Sunderland to help it set up, and coincidentally got like promoted into like bar management for this external bar outside the stadium. And for 13 afternoons straight, I managed about 120 staff on a bar, and I was 19. And it kind of lets you understand how people management works. I built, and for me to manage a team of that size that young, it really makes you really understand how the cogs work and how you want to bring in middle management and have one person that's in charge of part of the team. So if there's a problem, they consolidate the problem and then bring it to you. And there's obviously other employments that I did do. I used to work for like a land and landscaping business. Again, I went up to like management there, and I think some of it you're like kind of born with it. If you've got it, you've got it, and it's easy to grow in companies like that, and your work gets appreciated quicker. But it lets you understand how it works within a business much quicker, rather than if I now set up a business that was running 120 people, I would have first-hand experience without my own risk and cost of capital to get there. So I think that's why like industry exposure is good when it comes to managing teams.
Yeah, and the managing of the problems, because what I think one of the hardest things to get right is having the right team members who know what problems they should be solving and they should be dealing with, and what problems they should urgently bring to you, and not bring you every problem, but bring you the ones where it might be like Bezos says, a door that once you open it, you can't turn back, or it might just be a financially consequential decision or a client facing decision or something like that. You want to know what decisions. Well, you want to have a team that's good enough, know you well enough, know the business well enough, know the consequences of decisions well enough to know what decisions they should deal with and they can bear the brunt of consequences for, and what
Yeah.
needs to go to you and waste your time on. That mechanism is really fucking hard to get right when you're starting a business and growing a business, bringing in that middle management. We've gone through that teething pain this year, and just trying to isolate those issues. And sometimes things have happened and I've gone, why the fuck's that happened? And then I have to go in and kind of go, right, well, we shouldn't be doing that, or this, we should just follow this sort of process, or next time bring that to me, or next time go to this person, double check before you make that, because now we've got two different bits of information going to a client, or two different bits of communication going to something on site. And it can be hard to get that dynamic right, and you can end up wasting more money on middle management that can't make the right decisions if you're not there to infuse them with what decisions should they make, what decisions should they bring to you. Quite hard to get right. Another thing as well, that just talking about de-risking and trying not to distract yourself and staying concentrated. Dorian's done this, I've done this, and Jack, I know you've done this. Is you can bring in more of your supply chain. So if you're a developer, you can also be a contractor, you can also be a letting agent and whatever. There's a big caveat with all of that. If you're an established business, this is, I think, more of a focus. If you're starting out, I don't think it's not as much of a focus. But if you are established and you want to de-risk, then you could take on more of your existing supply chain, keep more margin in house, so keep more control. I think that's another way you
Yeah,
can
so
solidify yourself.
I mean, yeah, I think every action has a consequence, doesn't it? So in theory, there's benefits you get for it, but also in theory, there's other risks you open up. So the biggest reason why we've done it is, Jack mentioned earlier, our area is lower values and is lower margins, right? So you have to fight. One of our biggest, and then we forward sell everything. So our biggest risk left is cost control, and so we have to fight for every 0.1% of a margin. Basically, is a very, very brutal industry in that respect, and we have to do it on volume. So we can't really just rely on a main contractor, because very quickly we're going to exhaust that main contractor, because they're going to have other clients as well, and we have a different risk there. We are on a lot of sites, and we have a huge pipeline as well. We need that control. We can't be worried about the failure of delivery and all that sort of stuff. So the whole environment for us made complete sense for us to go into the supply chain by managing construction ourselves, and go even further, manage groundworks ourselves and open a groundworks division, even M&E now, and open an M&E division, and all bits like that. It just makes so much sense because of our landscape. And that's what I would say to people is, you have to be quite self-critical with is it the right thing to do, or is it you just doing it because you're, again, a hungry entrepreneur? If that makes sense.
Yeah, I would completely agree with that. I think so. When I think that one of the most important things to do when you are going up or down the supply chain and folding businesses into each other is make sure day one you're in a margin, because it's very difficult if you've got one business and you're managing a business to then add another liability into that group that's not in a cash flow positive position. And what that looks like is our first year of surveying was actually the most profitable year we've had. And that was because we were spending between 50 and 80 grand a year on surveying, and a surveyor doesn't cost that from a salary and a kit and a car perspective. It's actually, our margins way thinner now, even though we're set to turn over £500,000 this year, because you've got the infrastructure and the team. We've consciously made that decision to grow, but make sure day one there's no more problems or cash flow sat. It should be a cash positive decision, and therefore it makes life a lot easier. I really want to set up an estate agency, because we spend about £500,000 in estate agency fees in sales. And if I took on one really good agent on a really good salary, but mostly commission based, they would be able to sell all of our stock. And that would be a cash flow position day one. If I brought them in at the right time of so for example, in the next 6 months, we will have to sell about 65 to 70 units. By the end of that run, their salary is paid for, 3 times over. But I wouldn't bring them in now where we're not selling enough to sustain that cash flow positive position.
Yeah. I mean, you can also, it does depend. I agree that day one you want the margin, but it does depend on where you are. And if you're sat on good cash buffer or good reserves, or you've got good margin already, but you're trying to hedge, then you can forecast that if you fold in this part of your supply chain, it will take you 6 months to be in the green or 12 months to be in the green, and you're satisfied with that because it gives you, a stronger underlying business and stronger underlying revenue. Where you may hit, a bad market or something. I think you've probably done that by bringing the M&E and groundworks in. You probably weren't cash flow positive day one. I'm guessing you'd have to have hired a few people to get into that
No,
position.
those businesses were not cash flow positive day one, but I think maybe Jack's his point is completely correct, but maybe it was just a bit too literal. As long as we can start making returns back within both of those divisions, start making returns back within a quarter. Effectively, it's like it is still very, very quick.
No, to be fair,
It's like,
I think the two can be true. I think there is a literal sense that you could employ one staff member and they could start paying themselves over if you can fold it that
yeah, but
seamlessly.
even a state agency, it takes 3 months to sell a house, so it's there. I think and Jack, I was not speaking on your behalf, but your point is correct. I think you didn't mean literally one day. It's like within a very, very quick.
Yeah, I actually meant year one.
Yeah.
Yeah. That's correct.
And maybe that's the barometer. If any, for again for our viewers listening, if it should be that if you're going to fold something in, it should be that it's not a stretch. You don't want to stretch a fold. It shouldn't be something that, that's kind of, if we fold that in, it's in the same industry. It should be something that where you've got an existing client, you have an existing revenue stream, and within the fold of that revenue, you can take some margin or some control or some portion of that. That's like a true fold. You could take that in and it takes you a year to get to cash flow positive, or within a year you could be cash flow positive. Then it's probably a good decision to make, unless you're taking on some other kind of risk, like the M&E, for example, is something we wouldn't take on, or architecture we wouldn't take on purely because of the PI and the insurance risk, and I'm just not comfortable doing that at this stage of our business. But others may be more comfortable.
That was quite a what's that word there, like an oxymoron? Is you've said the insurance risk, but actually there's the risk and the insurance hedges that risk. How is that?
No.
How is the insurance the risk?
The PI, I just wouldn't want design liability I just wouldn't want that as a director. I wouldn't want to own an
I
uplift
suppose
scheme.
because it's all rolled up into one for you. Just out of interest, do you know how long it takes the average business to make a profit if they branch to an international country? So let's say you're trading in England and you want to trade in America or Germany, or the average time frame to branch and make a profit out of that branch.
Don't they say that on average it takes about 3 years for a startup to turn
Bang
a
on.
profit? So I'm just going to go with 3 years.
Yeah.
3 years.
Yeah, but to be fair, I've always said, like, when we start new businesses here, or like a new business, it's 3 years to get anything off the ground. You've got the first year of throwing shit at the wall, just understanding the sector, understanding the nuances, and making all the mistakes. The second year, you should start figuring out a consistent revenue stream, but you're probably not making any money really. You're probably just covering your costs. If you can start making money, great. Third year, you should know your shit, and you should be starting to triple down on at least a given revenue stream or strategy that's then allowing you to scale from the third year onwards. And if you can't do it in 3 years, you're either not good enough or it's not a good enough business model. But nothing should
And
take longer.
it's the compound effect as well. It's like your first early years. Well, actually, no, that's not correct. But in theory, your early years can be quite high growth rates because you go from 0 to 100,000, and obviously
On a
from a percentage point of view, is massive.
Yeah.
Do you know how much our development company grew in 2019 and 2020 400% and 250%. And now
That's what I
we'd
mean.
struggle to grow at
Yeah.
20%. It's just like when you get to
That's what I
that,
mean. Yeah.
when you
So
get to larger size, the percentage is it's just
Well, you would
it
you'd
flattens
struggle
out.
you'd struggle to do it sustainably because there are examples of people who've done it, but the
Oh
sustainability
yeah,
is not
and
there.
still be
yeah,
alive.
so
Yeah,
Yeah, yeah,
we've done it. We've done it, right? But it's in theory it's unsustainable. So our self-sustainable growth rate is actually quite high because of our the way we do it, and it's just is different. But you hit the nail on the head there, right? You can grow as you know as much
hmm
as the money pit will take you. Even
yeah,
OpenAI, I think the current losses to date are like 5 billion or something like that. 5 billion
yeah,
in losses. I think. Imagine if we guys put 5 billion towards property development. How big do you reckon we
yeah.
could get it within a
Funny
short
thing
space
is,
of time? And that.
that won't have any PGs on it.
yeah,
Free
No, I
roll
know.
of
Yeah,
dice.
yeah. Whereas if I want 100 grand loan, it needs to be 50% geared, first charge, company
yeah.
debenture, PG,
Mm.
unrestricted. You know, that's all.
They'll
Yeah,
change their
but
tune the
Yeah,
day before completion and reduce the LTV, but
yeah,
keep the
yeah, yeah.
leverage. Yeah,
yeah, but
yeah,
it's but
fuckers,
but it is
fuckers.
which is fuckers and it is annoying. But obviously
We need
we
to
are
get into AI, boys.
OpenAI is
Should we
different.
open an AI
Yeah.
software business instead? What do you do? AI. How would you help AI? It's like, right, okay.
I mean, there is
We'll give you 10 million.
Yeah.
there's do you know what we should get someone on, someone who's there's because there are different startups in the property space of people trying to find an AI tech or a tech solution with all the tech that's coming out. It'd be good to get someone on who's sort of at the coal
I know a
face of
couple
this.
of people that are in tech in our.
Yeah, that'd be good, mate. If we get
You
someone
gift
on,
will
just
be
pick their
good.
brain. Yeah,
We'll
let's do
get
that if
you
we
on
can.
from Searchland.
Yeah, yeah, but it'd just be good to see what they're seeing. Like, what do they think of the how much do they think the industry is going to get disrupted by this tech? Because property is very different. It is, it's bricks and mortar.
Yeah,
It's very
I think
slow
there
and
was an
archaic.
assessment of the 25 industries industries that are least adopting to tech, and I think construction came like 23rd. What like so basically third worst in every, and I think the worst were like public healthcare companies and
Yeah, yeah,
some other
yeah, yeah.
public transport companies. But yeah,
Public
it's
anything, just public
yeah,
anything.
just the public companies.
Yeah.
Yeah,
I can see why as well. I mean, and I'm speaking generally, but we're still classed as a small company, maybe medium, but still
no, you're not. Yeah,
small
you're
medium anyway.
medium. You're medium now. Remember, we did this
Yes,
before.
but still small medium. But trying to roll out right software across my construction groundworks and M&E side, um, and trying to get people on board with innovative stuff is actually really tough. Like it is actually really tough. I can see how there's such a with construction, it just fails. It fails, and and that's actually quite
Unpredictable.
interesting for us because we're trying to build our own software. But actually now because I got first hand knowledge of their own company as a guinea pig, I'm like, right, this if whatever we build, right, it's got to be easier than Excel because otherwise people are just going to use Excel. If it isn't easier than Excel, what's the point really in my simplistic mind? Because you're just not gonna get
Yeah,
people adopting it effectively.
yeah,
Yeah, a friend of mine is in tech, and he said the way to build a successful tech business is build something niche and sell into something that's not niche. So and have that very short runway of trajectory because you're not going to be there's more people out there that can fund to be bigger and better than you, especially if you're in the industry we're in. So if we moved into tech, the team that we couldn't resource, like CEOs of Google, someone that's high up in Amazon, whereas those tech startups that come from the higher management or the entrepreneurial spirit within the big entities can just pull the contacts and have it done like that. So it's all about building a niche platform that becomes desired, shows growth, and then exit. But timing is equally a thing as being as good with tech as you can, and sell it into the big corps that go, actually that's a good product, but we don't have that as part of our wheelhouse. We'll pay you a 20x multiple. See you later, and you go, thank you very much. I've put
Yeah,
in, and he also said you basically need a minimum of 150k to get anything off the ground and working from a development
yeah,
perspective.
and that
mm,
So watch this space, gang, because we're currently building an MVP at the moment in the software as a service space, and we are going to see whether if it adds value to us as a company. If it does, we're going to try and roll it out and spin it off and see if I can raise 10 million in VC funds. And on that note, I've got to do the school run, so I've got to go. Sorry,
Lovely
I
stuff.
thought
Well,
Stuart would be here by
to
now.
be fair, we could probably round up now, boys, because we've done it a good hour.
Round up, ground up.
Round up,
Round up
baby.
pod.
Well, hopefully,
Round up show.
hopefully the singing's not
Dorian.
too bad for anyone listening. But also, thank you for our listeners. And merry 2025. Hopefully, been an interesting episode. Just thinking about potential models and potential scaling strategies, the market for this year. Some nuggets there on diversification. So yeah, big love. Thanks for everyone listening.
Gary Trotter. What we could,
look
what you
at
got, what
him.
your listeners could do is over the
Fucking hell.
period, the Christmas period, have a bit of a think about what other service-based businesses you could fold into your company next year, given this episode. And if it's singing, like Dorian, I wouldn't take it up. Or if it's being the new Harry Potter,
Well,
Equally.
actually, for those who are watching, I want you to rate how much I look like Ryan.
Not far off, mate. Not far off.
Yeah?
Got the hair for it, mate.
These glasses aren't too far
I
off.
read
Yeah.
a book. It
Jeffrey
was
Dahmer.
called The Philosopher's Stone.
Right, fucking hell. Well, look, we release these
We
episodes.
should, yeah. Well, we
if
should
I've
create
got
our own
mine.
little movie. It's called the
I haven't
Chamber
got
of
my
Secrets.
specs
It's
here.
the development secrets. But
Fucking hell.
anyway,
Right, we need to get out of this episode quick. Right, big love, everyone.
Yeah,
Release these
wheels are
episodes
falling
every
off.
Thursday. Every Thursday, 5:30 a.m. We release them on Spotify and YouTube. So thank you for watching. Make sure you subscribe, share the episode with anyone useful, and remember the Ground Up Network is live, and you can see the links in the description of this video. Anyway, big love. See you next week.
Ta-da.
okay.
Ground up sound.